Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Trading Covered Calls and Short Puts. And, every once in a while, I read a comment somewhere out there on the internet that says selling covered calls is easy monthly income. Well, when we're trading covered calls, is it really easy to generate monthly income by selling options? There are some things we need to talk about. We really want to understand this, what is typically a pretty popular strategy, but it has pros and cons. So we're going to be placing an example covered call trade, talking through the pros and the cons. Should be a great discussion. Before we get to any of that, though, let me first of all say hello to everybody's chatting in. Great to see some familiar names, as it always is. Hello there, Will and Jay Richardson, Josh and Mark, see ya, K-Sim, Posh, Eva, everybody else. Thanks for joining us week after week. We always do appreciate your attendance and your contributions to these discussions. If you're here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the show, well, enjoy the presentation's recording, but be aware that you're invited to join us in the live discussion. If you'd like to be here, this is a Monday webcast series, and we kick things off promptly at 2 Eastern time. If you'd like to join us, love to have you here in the live audience. And as a treat, as it always is, for my live audience members, my very good friend Brent Moores is going to be hanging out in the YouTube chat, addressing any questions that I can't get to just during the flow of the presentation. Brent and I have now been working together for more than 20 years. I've been doing this for a long time. Brent's been doing it for like 5 years longer. So Brent's a great resource to have here. Thanks for having my back there, Brent. And Brent and I would also like to issue an invitation to everybody listening. If you have an account with X, you should be following your favorite presenters from Schwab there. You can follow Brent on X at Brent Moores CS. You can follow me there at Cameron May CS. Brent has pinned those handles to the top of the chat window out there on YouTube. But we'd love to have you there as followers. And it really is, for me, the best place to connect with me in between the live streams. If you reply to one of my posts on X, I just try to reply right back to you. But getting into this discussion, first thing that we always need to do is to be very aware of the risks associated with trading and investing. And that's kind of a key here. When somebody says something is easy, hold on, step back. Let's talk about risk. So this is important information. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, investment strategy. While this webcast discusses technical analysis, other approaches, including fundamental analysis, may assert very different views. Investing involves risks, including loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. Okay, so here's what we're going to be talking about today. I every once in a while, I do just read something on the internet that really sparks me to think, I need to address this. So when I hear the phrase investing and easy, trading and easy, income and easy, I always want to say, is this person giving the whole story? So let's make sure that we talk about this. We're going to be talking about trading covered calls for income. Is it easy to generate monthly income from that strategy, from selling options? Well, to accomplish this, we're going to go sell a covered call on an existing position in our paper money portfolio. But then we also want to weigh the potential advantages, but also the trade-offs when selling covered calls for income. We'll take a quick peek at the markets to see what's happening there. And if time permits, at the end of this discussion, we'll also take a look at our other current positions in our paper money portfolio, see if anything needs to be addressed on those positions. Kelly says it's not so easy. All right. Okay. I think, spoiler alert, it's not so easy. Everybody else go home. All right. Everybody, thanks for watching. Right. Anyway, let's talk about a covered call. So a covered call, just very briefly, if you're not familiar with the concept of a covered call, it starts with stock ownership. And hey, what do you know? We happen to own 100 shares of Walmart, and that is the traditional share quantity required for a covered call position. There can be some rare exceptions, but typically we need 100, 200, 300, multiples of 100 shares in order to pursue this covered call strategy. That's certainly more the rule than the exception. Okay, but we have 100 shares of Walmart, and as shareholders of a publicly traded company that is optionable, a trader can potentially enter into a contract with another trader where they're agreeing, hey, other trader out there in the options universe, I'm going to let you have the option to buy my shares at a specific price for a specific period of time. Let's get into a contract together. And in exchange for giving that option to another trader out there, we're paid what's called a premium. And that represents the income potential for this trade. That's what I'm going to do right now. Let's kick things off. We have 100 shares of Walmart. Let's go enter into a contract by accepting a premium payment. I'm going to go to the trade tab. And how about for this example, let's go out here to the 17th of October. And I want to tie this to what's happening on the chart. So let's go to the chart of Walmart. Here's what's been happening. You see a little bit of a trade history for Walmart. If you're wondering where these 100 shares came from, we originally sold a put option that was assigned at $95. So we collected a little premium here. We were assigned those shares that made us owners of the shares at $95. And since then, we already did one covered call on this, sold the $100 call option for the 15th of August. And that one actually expired right exactly at $100. The contract expired worthless. We made an 84-cent profit there to go along with unrealized gains at this point. If the shares are worth 107-ish, and we bought those shares for 95, and we've collected a couple of premiums along the way, now we've been making some money on this. But as we go to sell this new call, notice the stock has been rallying recently, but it looks like there's been a pretty good price ceiling all year long, right about $105. Let me just draw in a line right there at 105, just to point that out. And how about we do this? Let's go enter into a contract where we're giving someone else the right to buy our shares at 105. Let's go do it. We're going to go to the trade tab, go to the 17th of October for this, just for this discussion. We could choose a different expiration, but we'll go to the 17th of October and let's see how hard it is. Okay, easy may just describe the process of entering into a covered call, in which case I think we can make a strong case for it being quote unquote easy. It's not a terribly complicated thing to go execute an order to sell into a covered call contract. That's not where the trade ends. That's where it begins. But let's go to the 17th of October. Let's go to that 105 strike. That's right up there at that price ceiling. Looks like that's trading for, we might be able to get about $1.45 per share. But to place the order, here's how we do it. We just go to the bid price in our options chain for the contract we're looking to enter into. We click on that bid price, and that creates an order down here by default for 10 contracts. I'm going to change that to 1 contract. Each contract represents the potential exchange of 100 shares of stock. So if we did 10 contracts, that would maybe result in selling 1,000 shares. Guess what? We don't have 1,000 shares. We have 100 shares. So let's sell the 1 contract, 17th of October, 105 call. And let's say, I don't know, how about we do this? Let's right now, it looks like we might be able to fill for $1.42. Let's say that's what we need as our limit. So I'm going to go ahead and click confirm and send. We're going to try to sell this contract for $1.42. Now notice, was that a terribly complicated process to go to the trade tab, click on the bid price, change the contract quantity, and now we're ready to send this off? That was easy, conceptually, right? But we're going to enter into this 105 contract looking to collect $1.42 on 100 shares. That's $142 minus a 50-cent premium. Brings down our net minimum acceptable credit. Our potential income here is at least $141.50 if the trade fills. And let's send that order off. All right. Well, let's see what's happening. There's, okay, we sold it for $1.42. Was that hard? I don't know. It depends on the trader's definition of hard. The execution of the trade, not difficult. Some might call it easy. However, that does not mean that we now have a guaranteed income of $1.42 with no strings attached. Kelly says that's the easy part, right? Kelly, when you said earlier that it's not so easy, this isn't the part you were talking about. But the trader needs to do their homework and really understand what they're getting themselves into when entering into these sorts of contracts. So let's go through this very carefully. Let's open up our scratch pad. Give us some space to write up here. And we need to weigh the pros and the cons and the precise characteristics of this contract the traders just entered into. So our example trade today, let's make this bold. Go. Example trade is a covered call. The purpose here is to try to generate an income. And guess what? It actually has done that, but we can't go spend that income check just yet. All right. But it begins here with stock ownership. So the covered portion of this call is referring to the fact that 100 shares of stock are owned for every contract that we enter into. So in this case, we did buy the stock for for $95. That's what it was. That's what the assignment value was of those shares back here. But just be aware that we must buy 100 shares or multiples of 100 shares of stock. That creates the covered position. As the owner of those shares, now we can enter into these contracts to potentially sell those shares. I'm going to make one note here. Stock right now is trading at 101.82. Yes, $95 is what we paid for it. But what I want to compare the ultimate outcome of this trade to is what we started with on day one, the day that we sold the call. All right. So let's make a note that we're trading basically at 101.82. Right. But the second portion of this trade is to sell that call contract. In this case, we sold the 17th of October was the 105 call, and we collected $1.42 for that. All right, so now let's begin to explore. These are sort of the facts of the trade. And what's easy to have happen here is that our would-be income trader might just look at this and go, wait, oh, wow, Cameron, wow. I just collected $1.42 on a stock that's only worth basically $100. If I do some rough math there, that's 1.4%. Oh, I'm going to state it like it's a fact. I'm going to make $1.42 on a $100 stock in just 39 days. Wow, that's a high rate of return for just barely a month's worth of work, isn't it? Well, here's the problem with that statement. Maybe we're going to make money. Maybe we're not. It's going to depend net on what happens with the stock from here. Now, a nice thing is once we've collected this $1.42, let me throw out this question. Who can come in and demand that money back? Who can come in and twist this trader's arm and say, give me my $1.42 back or some portion of it or whatever? Nobody. Yeah, that $1.42 goes into this trader's account and it can stay there. If the trader wants to put the head in the sand and just let this go all the way to expiration and just see what happens, the $1.42 remains. But the stock is going to change in value. This is what I wanted to emphasize. For the next 39 days, this trader has accepted a payment of $1.42 or a premium of $1.42 per share. But in exchange, through those 39 days or through the 17th of October, at any time, the other party in this contract could decide, you know what, Cameron, I want your shares. I'm going to pay you $105 for those. That's their deal. They can't say, I want to pay you $100. They can't say, I want to pay you 102. No, the contract here is someone else has the right now to buy our shares for 105, nothing less, nothing more. That could happen at any time. So a trader who really doesn't want to sell their shares, this may not be the income strategy for them because selling the shares is always a possibility as long as we're in this contract. CS says trader only makes that if Walmart goes down $30 by 39 days. No, not true. Not true. No. This is collected. The 142 has been paid. That can be essentially just parked in the account. But then now we need to see what happens with the stock, because if we just let this go the full duration of the contract, they're going to be one of two outcomes. The other party decides to buy the shares, or the other party decides not to buy the shares. Sia says, what if Walmart does not cross 105? That's an excellent question. But we need to be aware of the precise terms of the contract that we're entering into, don't get too starry-eyed just about the potential for the income. We also need to realize some of the trade-offs. All right, here's one thing I want to point out with Walmart. We've actually been in this position now. We first started trading this thing back in January. What do you notice about the stock chart on Walmart since January? Has it just neatly climbed at a nice, easy, steady pace? Nope. It has run up and pulled back, gets run up and pulled back, gets run up and pulled back. And as a matter of fact, if you look from one monthly expiration to the next, you'll see a significant amount of volatility in just about every single month. So one of the trade-offs, one of the things that the income investor needs to be aware of with trading covered calls for income is it requires stock ownership. This is a big deal that we have to own these shares because we are now on a roller coaster ride to the next expiration or whatever time frame we've chosen for the duration of this trade. This one, as a matter of fact, goes out here to October 17th. We could have chosen some other expiration. But is it likely, as much as the trader might prefer for this to happen, they might prefer for the stock to just sort of go up gradually, just a nice, easy coast to our expiration through our contract period. Is that likely to happen? Nope. Most stocks will move between the time we enter into that contract and the time the contract is either assigned or it's not. All right. Or we choose to exit the contract. But if we stick this out all the way through October 17th, at which time we'd be in position to realize our $1.42 of income, our stock is likely to rise and fall in value. So let's talk about what that means overall. What if our stock runs up? This is what the trader might be thinking. Maybe it'll run up, get close to 105. Man, maybe we'll just pull back and we hit the finish line. We're still below 105. What's likely to happen in that scenario? Well, this would leave this contract what we'd call out of the money. Someone has the right to buy our shares for 105. They're just not worth 105. So even if they have the contractual right to buy them, they're probably not going to. They could if they wanted to. Not to say they can't. It's just they probably won't. They might say, Cameron, you know what? Forget it. Keep your shares. And I might go, okay, good. Because I still get to keep the shares. I only paid $95 for those. They're worth more now than what I paid for them. And I now have $1.42 of realized income, realized profit from selling into this contract. And the contract time frame's over. Awesome. That is a positive outcome. Now, Mark says the next bull run might take it above 105, though, since it beat earnings a couple of weeks ago. That's what Mark just pointed out in the chat. Yeah, that's a possibility. What if it doesn't do this? Let me remove this part of the drawing. And what if it just, let me just extend this to the right. It shoots up through 105. So let's say as we're getting closer to the end of this contract, the stock goes above 105. What might happen then? It might happen before expiration. It will almost certainly happen at expiration if it hasn't already. If our stock's above 105, that literally translates to someone has the right to buy shares for 105 that are worth well more than 105. Are they going to do it? Yeah, they're going to do it. Very few exceptions. They buy those shares. And that's when this income trader might say, wait a second. So I'm selling my stock at a discount, and it might be a steep discount. And in exchange, I only got $1.42 of income? Ouch. Yep, that's a possibility. Now, would that be, Mark, who else was asking? Would this be a negative outcome for this trader? Just mathematically, if the stock goes up and the trader is required to sell the shares at 105, yeah, they'd be required to sell the shares for less than they're currently worth. But would that mean that it was an unprofitable exit? No. In this case, we bought the shares for 95, sold them for 105, so that would be a realized gain. Here's how the math would work on this. Realized gain of $10 on the stock. Realized profit of $1.42. Just because a contract gets assigned doesn't mean we lose the premium that was paid. No, that premium is now retained permanently. This is now a realized profit. So made $10 on a stock, made $1.42 income from selling into the contract. Now, this is in addition to the realized gain on the earlier contract here. It's in addition to the 162 realized on the put that we originally sold. So overall, we'd be looking, what does that work out to be? Maybe a little bit over $13 of realized profit. So getting called out, that's what we refer to this. When we sell a call for income and that contract gets assigned, we say it got called out. That can sound spooky. It's not always spooky. Matter of fact, most of the time, I'm always tempted to say always. It's not always. Somebody could find a way to mess this up and lose money even getting called out. But generally speaking, if we get called out, the trade is a profitable trade. It may not be an optimally profitable trade compared to maybe just holding the shares and watching them take off. But one of the trade-offs here is that the upside potential is capped. So I want to do just a quick exercise here. Let me just summarize very quickly why some traders like selling covered calls for income, but then I also want to just list off some of the trade-offs. So why do some traders like selling covered calls for income? Well, it can generate potential cash flow on stocks that we already own. It can provide some cushion to the downside if the stock starts to misbehave, because if the stock goes down in value, well, at least we have some income to help offset that loss in capital value of the stock. All right. It's not a ton of cushion, but it's just the amount of whatever the amount of the premium is. If the stock falls more than that premium, it's net not positive, but it's still better than not having sold the covered call in the first place. It's also a strategy that can work in a sideways market that wouldn't really be productive if we just buy stocks and they go sideways. Well, even we have a big portfolio of stocks, if they're all going sideways, they're not doing anything for that trader. Generating income can add profit potential that's not otherwise likely if a stock is just going sideways. Ooh, Bessie says, how do you set up the closing trade on a covered call? I can show that, Bessie. But those are some of the things that can attract traders to this strategy. The primary driver is typically just a desire for income. And this is not an inconsequential amount of income, just in this one example that we've selected here. Now, what are some of the trade-offs, though? When somebody starts to say, this is easy. Well, number one, we do have a limited upside potential. How much is the most, including the premium, that the trader could make on this scenario? Well, if the stock is worth 101.82 right now, and we're required to sell at some point at 105, that means for the next 39 days, there's only $3.18 of remaining potential in the stock. And we can add to that $1.42. So it's about $4.50, $4.60 when taking both into consideration. So there's limited upside potential. There's also limited risk potential. Risk protection. We've talked about this in previous webcasts. Some traders think that this is like insurance. It's not insurance on our stock. It adds a little bit of protection, a tiny bit of buffer if the stock just comes down a bit. But if the stock falls by more than the amount of the premium collected, net, the trader probably would have been better off if they thought the stock was going to collapse, just selling the stock. But possibly the biggest way to look at the risk, the thing that makes this not so easy, is it requires stock ownership, and stocks can do this. They can go way, way down. And if we're the owners of those shares and the shares collapse in value, that income becomes small consolation. So there are trade-offs that make this not such an easy strategy. Placing the order is easy, but it's not always easy to realize, oh, looks like we just got out of another trade there. In any case, not always easy to realize a profit in these scenarios. So let's talk about what a trader might do in their efforts to maybe pursue income. Anyway, now that we're familiar with the pros and the cons of the strategy, what might be some considerations for those traders who are okay with that and they just want to go sell covered calls? So let me let me hit the pause button right there because I do want to call this out. Eva pointed this out, and I haven't given her credit yet. There is a survey out there in the YouTube chat window for those that are here in the live stream audience. We don't always get this opportunity. So if you would do me this favor, if you'd click that survey link right now, and you might need to scroll up a little bit, or if Brent reposts that, just click on that survey link, have it populated on your screen so that you can fill it out after the webcast is over. I'll just tell you a couple of things about this survey. If you've never filled one of these out for us before, they're super short. 2 multiple choice questions, a comments box, and a suggestion box. That's all there is to it. So you could just go click, click, and you might be done, or leave some comments and suggestions. But I always just want to promise you that if you take the time to fill out one of my surveys for one of my webcasts, I will always take the time to read through those comments, and I read that data, and it always helps. So thanks for doing that for me. Always appreciated. But let's go back to our trade on Walmart and just see if this lines up with how some traders might structure a covered call. Now that we're aware of the pros and the cons of the strategy, well, how do we choose a stock, first of all? What are some of these considerations? Here's one way to think about which stocks to choose when selling covered calls. Covered calls require stock ownership. So maybe they ought to be stocks that that trader or that investor doesn't mind owning. So some of the qualifying characteristics might be that the stock is in a sector that the trader thinks is doing well, or maybe they need a little bit of exposure to that sector to fill out the diversification of their portfolio, whatever their sector requirements might be if they have one at all. They might also emphasize the health of the company in whatever manner they assess that health. Maybe they go look at the fundamentals, and they look at growth metrics if they're a growth investor, or value metrics if they're a value investor. But yeah, there can be sector considerations, there can be fundamental considerations, but some more common considerations that tend to be not truly universal, but probably a little bit more widespread are price per share. It can cost a lot to buy some stocks. 100 shares of some companies is a huge investment, might be outsized for some portfolios. So price per share can be a consideration. Liquidity is a big consideration. That means how much volume does the stock trade on an average daily basis? Illiquid stocks with not a lot of trading volume tend to have illiquid options, and those options can have all sorts of pricing issues. We'll see the bid price and the ask price, the spread between those two prices widen and widen, makes it harder to trade those profitably, even with like income strategies. And then a trader might also look at what's going on with the chart. If a stock, for some traders, for some investors, they prefer to buy stocks, for example, that have generally been going up, under the assumption maybe that momentum will continue to draw that stock price higher, because as owners of shares, even though income may be the impetus for the trade, appreciation might be preferred as well. Having the stock collapse in value during whatever time frame that investor or that trader owns a stock when selling covered calls, that can offset the whole benefit of the income anyway. All right, what are some other things we want to talk about? What about the option that the trader enters into? You'll notice I chose, for this example, the October 17th expiration. I did it kind of to diversify in this portfolio. I already have a lot of contracts that are expiring in September. So diversifying the time frame, moving out to October, maybe a trader does that occasionally. Another thing is when selling options for income, interestingly, the motivation for the trader is probably to sell as few days as possible. Selling short-term contracts means that we're just not in an obligation for very long. So if we're entering into a contract that expires tomorrow or 5 days from now, that could make the trader feel a little bit better. Okay, nothing big is likely to happen in the next day or the next 5 days, at least if we compare that to the next month or the next 2 months. There's not as much time for the stock to do something unanticipated, and that might make the trader feel better. But the trade-off there is if the stock doesn't have much time to do anything, the premium's not probably going to be likely be very high. So commonly the trader is looking to strike a balance between not being locked into a contract. Locked in, that's the wrong term, because a trader has the option to buy out of the contract if they're able to buy out in a good liquid contract. It's not that they're locked into this contract for the full duration of the contract time frame, but the trader might be looking to strike a balance between selecting contracts with an adequate number of days to have a high enough premium, but not to go out so far in time that they're sitting around twiddling their thumbs for weeks and months on end, waiting to see if they're going to realize that income or not. So for some, there may be a sweet spot. Some might define it as being somewhere between, let's say, 20 days from expiration out to 40 or 50 days from expiration. That's just one rule of thumb, but not everybody does it that way. So these contracts that I selected, 39 days, they kind of fit right in that window. So Mark says most of the time, if I can get a good premium, now I'm going to throw this up in air quotes because this is Mark defining for Mark what a good premium is, right? If I can get a good premium for 7 days till expiration, I figure there's probably a reason. That's a really good observation there, Mark. Let's say that on Walmart, we had decided to sell these September 19th contracts, and instead of being $1.42, there's $10 that we can collect. Wow, we're going to make 10% in a few days instead of 1.5% or 1.4% in 39 days. That sounds amazing. Let's do that. What does an income trader who's been doing this strategy for a while, what kind of alarm bells go off in their head when a premium seems too good to be true? Well, guess what? The premium actually is true. It's just there's something behind that premium. When premiums are really high, when traders are offering to pay a lot of money for contracts, it's because they think something big is about to happen. And when we're in one of these contracts, the trader typically, the covered call trader, typically doesn't want something big to happen, because something big, if the stock collapses, ouch, we're the shareholder. We're the ones with the risk in that scenario. If something big happens and the stock blasts off, we can also say ouch because we have a cap. All of those profits above a certain break point are going to somebody else. So yeah, when we see very large premiums for very short periods of time, I totally agree with you there, Mark. Yep, it may be a little bit of a hold on, not necessarily a red flag, but like a caution flag. I don't watch NASCAR. What do? Is that the checkered flag, or is that just the end of the race? I can't remember. Anyway, it's a warning. All right. What else do we have? Selecting the stock, selecting the time till expiration, strike price selection, which contract to get into. Well, what some traders will do is they'll look for an apparent price ceiling, because if the stock already has a ceiling, they may not feel so bad about imposing a numerical ceiling by selling a contract. If they don't think it's going above 105 anyway, all right, maybe we get into a contract where someone has the right to buy shares from us for 105. We don't think it's going to go above that. Now, it could. Just because we think it's not going to go above a certain level, markets are just going to do what they're going to do, right? Let's see, what else? Yeah, Mark, kind of going back to your point, a consideration when selling covered call contracts is things can come along and screw up our stock during the contract time frame. One of those is an earnings announcement. Some traders just prefer not to be in covered calls over earnings. So for example, with this most recent earnings announcement on the 21st of August, we sold a contract that expired 2 days before that. That way, had the stock just really blasted off, we didn't have an artificial cap limiting the upside potential. Now, in this case, it actually fell back, so we didn't have the little cushion that the covered call might have provided at that point. So there are pros and cons to that decision as well. But my bottom line here is risks exist with this strategy, so it's not easy money. It's easy to place the order if we define it as placing the order the way that I did it. but that doesn't mean it's just easy money. Anyway, R1 says, what kind of criteria did you use when you made the original long call? So it wasn't a long call there. It was actually a short put, sold a put. If you want to see the logic of these previous trades, our sessions are recorded. So you can go back. Not every webcast that we do is recorded, but do yourself a favor. If you're not subscribed to our YouTube channel, it's called Trader Talk Schwab Coaching Webcast. You can go down in the lower right-hand corner right now, click on that subscribe button. It only takes a second to subscribe, doesn't cost anything, but this is where we house our previous webcasts. And if you want to go back and look at these discussions, you can just go right here to our playlists. And this one is called Covered Calls and Short Puts, Trading Covered Calls and Short Puts. But if you scroll down toward the bottom, I think Barb was the most recent. Yeah, she filled in for me recently. So no, that's getting started with options. Where's my covered calls and short puts? It is, got a little ahead of myself here. There it is. At least I thought I saw it. And I have it's been a little while since I looked this up here, but I'm determined to find it. Covered calls and short puts. Yeah, there it is. It was Ben. Ben filled in for me. So the way to find this, if you're on that playlist, just scroll on down toward the bottom and then go up about 3 rows. There it is. Trading covered calls and short puts. You click on view full playlist, and then you can go back through the entire history of all the webcasts that I've taught in this webcast series. So if you had an interest in, let's say, this put, this discussion was back on January 28th. So that was about 7 or 8 months ago. And these have little timestamps on them. So you'll notice here it says 8 months, 8 months. You can just go back and find that. So this is Mike. That obviously wasn't me at that time. So right there would be this one when we sold a put for income. All right. So that's going to conclude the part of the discussion that's addressing the question that I asked right up front, but we have a little bit of time. Let's go take a quick peek at the markets, and then we're going to take a peek at our existing positions. Yeah, the markets have just continued their run to the upside, although it looks like recently we've been running up and pulling back, running up and pulling back, running up and getting maybe a little bit of a hesitation here. If we start to pull back, that's actually a time when some traders look to sell covered calls, when they think the stocks are likely to not go up in value. So capital appreciation isn't delivering to the bottom line of the portfolio. Maybe that's a time to look for income instead. Now, that's not a guarantee that that's what the S&P is going to do. But for some traders, that's just what they look for regarding timing of entry with covered calls, is to look for when they think stocks are a little bit top heavy. Now, let's go see our other existing positions. So Walmart, we sold that call. That's down here. Let's right click. Let's move that to our covered calls and short puts group. So now we see the combined position there. The shares owned, the call that we sold. And just as a quick recap with Apple, we're in a covered call right now, the 225 call. That stock has gone well above 225. So that is in position where it might get a sign. It's not going to in a paper money account, but it certainly could in a real account, which would be devastating, right? No, not devastating. If we get called out at 225, which is where we are right now, we've recently sold a 19th of September 225 call. That would be above our break even for this trade overall. We wind up netting some gains on this trade, but this one's had kind of a complicated history. Originally bought the shares way back here through the sale of a put, actually, an assigned put. And then the shares just collapsed in value. And they've been in recovery mode since then. But along the way, we've made some profits from premiums collected that have helped sort of ease that pain. Notice the stock has finally gotten up to a break-even point as far as the stock is concerned, but those premiums have actually lowered our break-even point for the trade overall down to about 223.34. So Apple's doing okay. And when you look at this profit or loss open, it says negative. That's not including all the realized gains along the way. Nextera, another covered call position. This one, let's see. This one sold a put that was assigned at the 72.50 mark. We've sold a call against the assigned shares, realized a 55-cent profit there. We've sold another call more recently for $1.12, but that stock is sinking. We might want to take a close look at this. Maybe next week we'll see if we maybe need to wrap this one up. Let's see. Mark, you said the way you've managed those Apple positions is awesome. Thank you, Mark. It's definitely helped out with the trade, even though the stock kind of suffered. Our T-Mobile position from our most recent discussion, this was our put that we sold 2 weeks ago. Didn't work out. So we've had a pretty good year. Covered calls and short puts. It's been a pretty cooperative year, but still possible to lose money from time to time, even with bullish trades in a bullish market. With T-Mobile, here's what happened. Sold a premium, put a stop in place, and then this happened. So we sold that 19th of September 250 put, got a gap down. That one got stopped out. We lost $7.25 on that trade. Losses happen. Tesla, we have two more. Tesla's a covered call, sold the 365. Stock's only at 346, so it's well below our strike. Here's the history for Tesla. For this one, we just bought the shares all the way back here at 233.07, and our shares have done really well. Along the way, we collected a profit here on a call. 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 And right now, we're in another call that we haven't gone up through that strike. Still out of the money. Even an out of the money contract could be assigned, but that one's in good position. So what we'd really like to see from here is stock to go up, but just to stay below that call strike. And we might make another realized gain on this call. Possible. We'll see. Finally, we have Visa. Final covered call. We're in 100 shares for $330. Sold the 360 strike. It's only at 342. That one has almost evaporated entirely. Maybe we'll exit this one next week as well. But there's the history for this one. Assigned the shares at 330. We had already entered and just closed and weren't assigned on some puts already. So that was about $3.50 of premium collected there before the shares were assigned. We've sold the one call. That one's out of the money. So we're above break even for the price of the stock. And that call looks like it's in good position to assign or to not be assigned and just expire. We'll revisit that one in more detail next week. So that's how our current positions are doing. So overall, doing great, except for that T-Mobile position that was closed out at a loss. But time for me to let you go, guys. I hope you enjoyed this discussion. I wanted to talk through this idea that covered calls, selling options for income is just an easy money process. No, it's not easy money. It's a relatively easy thing to enter an order for. But after that, it's up to what the stock does and how the trade is managed. Risk exists, and we just need to be aware of that. Okay, so time for me to let you go, everybody. Thanks for giving me your time today. It's always appreciated. Brent, thanks for helping out in chat. Make sure that you are subscribed to the channel if you haven't done that. Also, make sure that you're following Brent and me on X. You can find Brent on X at Brent Morris CS. You can find me on X at Cameron May CS. So if you have an account there, give us a follow. If you reply to one of my posts, I try to reply right back to you. Like last night, I was sitting out by the lake, visiting with a neighbor whose house looks out over the lake. Just a nice evening. So I just took a picture and said, hey, let my followers see what I'm looking at. It's not always about business, but love to see you there as a follower on X. Everybody, go have a great day. Thanks for all the thumbs up already. I can see 154 people watching the live stream. It looks like about 47 have already clicked that thumbs up button. That's very much appreciated. That is like applause to your presenter. It also gives a boost to our webcast, and the YouTube algorithm helps more people find these webcasts. That's definitely appreciated. I will see you in a future webcast. I'll also look for you on X, but whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.